What if I told you there might be a way to make money just by trading in a circle? Today, we're going to dive deep into the world of high-speed crypto trading to hunt for what's called a perfect money loop. We're going to explore a strategy called triangular arbitrage and see if it's actually possible to find free money just hiding in plain sight.
All right, so let's get right to it. Here's the big question. Can you take, let's say, some Bitcoin, trade it for Ethereum, flip that Ethereum for Solana, and then trade it right back into Bitcoin and end up with more Bitcoin than you started with? Is it literally possible to make a profit just by shuffling assets around in a loop?
Well, this whole idea has a name. It's called triangular arbitrage, and it's all about finding these teeny tiny, blink and you'll miss it, price gaps between three different assets. You follow this simple A to B to C and back to A path, hoping you come out ahead. Sounds easy enough, right? Well, yeah, as we're about to find out, the devil is seriously in the details.
So, how do you even start to look for these things? I mean, the crypto market is just this chaotic sea of data flying everywhere, right? You need a blueprint. The whole idea is to take all that noise and turn it into a clear, usable map. Basically, a treasure map, where the profits are marked with an X.
At its heart, the process really boils down to four main steps. First, you got to grab all the latest prices you can. Second, you build that map. Programmers call it a directed graph. But think of it like this. Every currency is a city, and the exchange rates are like one-way streets connecting them. Third, you search that map for any three-stop round trips, or little triangles. And finally, step 4, the moment of truth. You run the numbers to see if a trip around that loop actually made you any money.
And you know, the math behind this is surprisingly simple. You just take the exchange rate for your first trade, multiply it by the rate for your second, and then by the rate for your third and final trade. If that number you get is anything greater than 1, boom, you've found a profitable loop. But if it's less than 1, well, you just paid for the privilege of going in a circle.
Okay, so let's look at the first attempt to build this engine. This is what we'll call the fast and simple path. It's a really optimistic model that's built on one huge assumption, that you can always get the absolute best price no matter what. So this first method uses what are called tickers. You can think of a ticker as just that big, flashy price you see on the screen for any given trading pair. It's the headline number, right? The one that's meant to grab your attention. More specifically, it uses the bid price, which is what you get when you sell, and the ask price, which is what you have to pay when you buy. Our simple model just grabs these two headline numbers to draw its treasure map. It's super clean, super simple, and incredibly fast.
But, and you knew there was a but coming, right? Here is the massive catch. This method is way, way too optimistic. It assumes you can trade any amount of money you want at that single best price. It totally ignores the reality of how markets actually work, and that, as we're about to see, is a fatal flaw.
So, the big moment arrives. They run the code. Does this optimistic little engine find the free money? Not even close. In fact, it consistently lost money. We're talking a loss of about 0.84% on every single loop it thought was a winner. So, what on earth is going on here?
And this is where that optimism completely falls apart. The culprit? Good old-fashioned trading fees. See, you get hit with a fee on every single trade. Let's say it's around 0.26%. Well, you do that 3 times, and suddenly you're down nearly 0.8%. So that little loss we just saw, that wasn't a bug. That's exactly what you should expect. The theoretical profit was a ghost, completely vaporized by the real-world costs of trading.
Okay, so attempt number 1 was a total bust, all thanks to fees. But what if we build a smarter engine? You know, something that actually knows how the real world works. That brings us to our second approach, adding a much-needed reality check. This time around, we're not just looking at that one flashy ticker price. Nope, we're looking at the whole shebang, the entire order book. That's the full list of every single buy and sell order out there with all the different prices and amounts. This gives us a much more detailed and way more accurate picture of the market.
And this is absolutely crucial because it lets us account for a concept called slippage. See, in the real world, if you try to make a big trade, you instantly eat through all the orders at the best price. Then you have to start taking the next best offers and the next, and so on. Your average price slips away from what you expected, and it's always for the worse. This is a massive factor in real trading.
So here is the real game changer.
This new model actually simulates a real trade. It pretends to put down, say, $200 on each leg of the arbitrage loop. And by doing that, it can calculate a much more realistic price, one that accounts for the slippage we just talked about. This has to be the ticket, right? This is how we find the real profit.
All right, so our new model is smarter. It's way more realistic. It accounts for fees, it accounts for slippage. It should be able to sift through all the noise and find those genuine opportunities. Or should it? Because this is where our search for free money takes a really interesting turn.
So, they run this super smart, super realistic code. And what does it find? Nothing. Zilch. Nada. The script that was designed to spit out a list of beautiful, profitable trades came up completely empty. So what gives? Where did all the money go? Well, there are a few clues. It could be that the search was just too limited. Or maybe there just weren't enough connections between the specific currencies to even make a full circle. But the most likely answer is also the most profound. It's that these opportunities do exist, but they flash into existence and disappear so incredibly fast, we're talking microseconds, that an algorithm like this one just isn't fast enough to even see them, let alone act on them.
And that, right there, is the big takeaway from this whole experiment. It tells a pretty powerful story. The simple, optimistic model was chasing ghosts. It found profits that were really just losses hidden by fees. But the second, realistic model, it revealed something even more important. Most of the time, the treasure map is blank. In the real world, for most traders, these perfect, profitable loops are basically a myth.
Which leaves us with one final, kind of huge question. I mean, think about it. If our little experimental script had this much trouble, what about the giant, super fast algorithms that big trading firms are using? They are all hunting for the exact same tiny gaps, just millions of times faster. So what does that tell us about the market itself? It suggests that the absence of profit is actually the most important discovery, because it points to an incredibly efficient system. Can a truly inefficient and therefore profitable market ever really exist for more than a fraction of a second? Now that's something to think about.